Welcome to the Airmere Roundtable. Today is the 8th of October, and my guest is Ali Pashaei. Hi, Ali. Nice to have you back.
Hi, Tom. Good to be back.
And before we get too far into it, happy Columbus Day, everyone. And just a normal disclosure that Airmere Corporation is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations, and past performance is not indicative of future results. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, I will stop my share, and you can share your screen.
All right, great. So let's get started. If there are any questions, I guess people can jump in. I'll try to pause every once in a while, see if there's any questions. So,
and I'll monitor it.
Okay, yeah, thanks. So, hi everyone, good to be back. I did see some familiar names on the attendees, so good to see you guys or hear from you guys. What I wanted to talk about today is what I'm just calling exotic butterflies, which is anything other than a typical standard butterfly that typically people are familiar with, and kind of talk about why I like them and how I manage them. Hopefully this is interesting to some folks. Standard disclaimer, Tom went through his, here's mine. Just be aware that there's risks involved. Any results or any trades we're talking about is for educational purposes, and results are hypothetical. So be very careful trading. It involves risk, especially trading options. With that said, the agenda, I want to go through a real quick background of just butterflies and broken wing butterflies and things like that, what my experience has been with them. Talk about two exotic butterflies variations, what I call put USBs, unbalanced skip strike butterflies, and a trade I called Sphinx, the bullish variation of it. Just talk about those real quickly, go through examples of how I would manage them, and then just my overall philosophy with regards to, or approach overall to trading options, and more specifically to butterflies. So here's me, quick background. In case you're not familiar, I've been trading options for quite a while, since 2001. I've worked with Charles Cottle, risk doctor, and I'm currently working with him, in fact, now in a mentoring program. I trade my own accounts and manage family money, and I do some consulting and mentoring as well. Run a private group, Google group. In case you're interested, shoot me an email. It's free, but it's by invitation only. Anybody's welcome. Here's a quick background since I mentioned Charles. He's one of the co-founders of Thinkorswim. I consider him a friend and a mentor, and in fact, he might be online now. Just overall great guy. And just jumping in, here's a quick history of my experience with butterflies. I've been fascinated with these trades ever since I started. About a year into trading options, so I've been pretty much actively trading butterflies since 2002. I know broken wing butterflies, which I really love, are great trades, have become more popular in recent years. I've been trading them since 2007, really love them. They're great trades in my opinion. The first variation that I traded, there's so many different ways you can configure them, but the first variation that I traded was, for lack of a better term, I'm just calling it a flat out of the money put BWB. I'll show you guys what that looks like in the next slide. It's a relatively safe trade, and it has a very high probability of success, and it the returns are somewhat low, but they're very consistent. So and when I was trading them fairly actively, I was kind of looking to make 2 to 5%, sometimes a little bit more, going out 30 to 90 days, kind of get in, get out, repeat and rinse kind of an approach. The problem is you'll see that it has a tail risk. So that's one of the reasons I'm not doing these, or I haven't been doing these in a long while. And this is what it looks like. So it's basically a typical, if you're familiar with broken wing butterflies, in case you're not, it's a butterfly trade, but one of the legs is stretched out, so they're not equidistant. This one is pushed as far out of the money as I could go, and typically done for flat or even money, slight credit, slight debit, and the placement of the shorts or the longs could be based on either just option pricing, you're looking at deltas, kind of low delta stuff, or support resistance. But what I would try to do is push them as far out of the money as I can to, avoid as much of a downside risk as possible. And as many of you know, if you have been trading these, that the T+0 line slowly rises over time due to the decay of the out of the money options, which is decay more rapidly than the ones that are near the money. And this T+0 line rises, and you get moderate movement up and down during this time. You can kind of make a quick buck. You don't take these to expiration. You make a little bit of money in these, get out, repeat and rinse. But as you can see, it requires quite a bit of margin. People call that margin. I actually call it risk because, yeah, theoretically, it's very difficult to lose 30 grand on this trade, but I still consider that potential risk. So this is the part that I never liked. Luckily, I didn't get hit with any of these. I avoided them in 2008. Just the market was a little bit too crazy. So I consider myself a bit lucky, never having to suffer a major loss with these things. They work consistently, but I never really felt comfortable. So here's a common butterfly, which looks a lot better in terms of risk. It's not pushed out of the money as much as what you were seeing here. So, and as you can see, it has a lot lower risk to the downside, moderate risks, small level of risk to the upside, and there are a lot of variations to this that are traded these days, and I like them, and I do trade these on when for me important thing is pricing and the volatility conditions and the market conditions. So based on the right conditions, I really like these and I do trade them. Back in February, when the market was really going crazy up and down, we had wild swings. I was really trading in and out of these things quite a bit. To me, that was a great environment, a high volatility environment to be trading these. This variation is the one that's the first, let's call it exotic variation that I want to talk about. Now, I consider BWBs also exotic. It's really not a standard butterfly. But these ones are a little bit more twisted. And what it is it's a mouthful. It's an unbalanced skip strike butterfly. So just for short, I just called it a put USB. And what it is that it's not equidistant. Now, when you're creating a butterfly, there are two variables you can mess with. You can mess with the quantities of the options, the vertical spreads that you're purchasing or selling, or you can mess with the distance of the long strike to the short strike. So in a typical BWB, you see one of those variables is changed, meaning the distance. So in this case, it's a 40 by 50, I believe. Yeah, the 40 by 50. So it's same number of contracts. It's 10 bear put verticals facing 10 bull put verticals, but the bull put verticals are 50 wide while the bear put verticals are 40 wide. So we're changing the distance, not the quantity. Over here, what you're seeing is that we're changing, there's a variations in the distance and the quantity. Now, the distant variation is kind of backwards. Instead of making the put vertical as leg, if you will, wider, that actually is shorter. So it's actually 40 by 20, but we're selling more of these. We're selling more of these to offset the fact that this is a wider vertical, okay? Now, the way I kind of, let's see, I think I've queued these up so I can show you guys on the platform. So here's the standard broken wing butterfly that you're familiar with or you may have seen, and it's that 40 by 50. And here's let's just make this even. This is what's called a skip strike butterfly, and I'm using the terminology that Charles Cottle uses in his book, and he calls these skip strike. So, and the reason is because we're actually skipping. This leg here skips a strike to get to the next leg, and let's say this one doesn't skip, but this one skips a leg. So that's why it's called a skip strike. And it's a balanced butterfly. It's a balanced butterfly. And what it is, it's a 10 by 20. So we're buying 10 verticals and selling of 40 wide, and we're selling 20 verticals 20 wide. And that creates a balanced butterfly. That creates a balanced butterfly. And all I'm doing is increasing the number of short put spread contracts. So if I just sell 2 extra ones, it's going to create now an unbalanced variation, and that's exactly what I'm calling the USP. It's an unbalanced, because it has more short verticals here, variation of a skip strike butterfly. So let's just do a quick compare and contrast. But before I do kind of go through and do a comparison, let me just break it down a little bit better, show you guys in the slides what exactly these things are. So here's a screenshot. It's taken from, with permission, from book by Charles Cottle. It's a great book. I recommend it if you want to get real deep into options. It's basically, if you think about construction of butterflies, if you place a butterfly at this let's say the 90 strike, and then you buy 2 butterflies at the 95 strike, so they intersect, you end up with this. And here you see basically that effect. You see that a butterfly placed centered at 90, 2 butterflies placed at centered at 95. When you add up this inventory, you get a 1 skip a strike by 3 by 2, and you get this configuration. So basically, if we dissect this skip strike butterfly, it has these 3 what's called baby butterflies inside of it. And it's what I call backloaded. Backloaded, I mean, is that the majority of the inventory of the butterflies are concentrated at the back end of it, not the front end. It's not evenly distributed. The babies are focused back here. You know, so that kind of gives you a quick overview of what the subcomponents are. Here's another visual showing you the concept of a skip strike. I mean, there's different ways we can do it. This is a regular butterfly. It's a 1 by 2 by 1. We can do a 1 skip a strike 3 by 2. We can do skip 2 strikes 1 by 4 by 3, and so on and so forth. But one of the things you'll notice that makes everything balanced is if you multiply the number of the vertical spreads involved here by the distance. So we have one vertical spread here multiplied by the distance being 2 units. So that's 2. And then over here, it's one unit separation, but there's 2 of them. So 2 times 1 is equals to 1 times 2. That's why you get a balance. And over here, you get 1 times 3, which is 3, versus 3 times 1, which is 3. That's why you get the balance effect. So, and this is also this is how you can construct a balanced skip strike. And the next slide is just showing you how to unbalance them, is by varying the distance as well as the quantities, so you can come up with all sorts of configurations when you have those 2 variables that you can change around. And you can create an unbalanced version. And there's really no standard name for these other than calling them unbalanced butterfly configuration or ratioed verticals. You know, we're changing the ratio of a bull vertical versus a bear vertical. So it's very difficult to, there's no standard name for that. So let me make sure I've not lost anyone in at least defining what this thing is, so that I can kind of give you a comparison of contrasting a standard BWB with the USB. Are there any questions so far?
There's just one from Al Geeson. Ali, can you show the rut trade you entered last week as an example of how to manage a position? And Sam, that we are recording.
Yes, I'll get into that as well. I have that in actually one of the slides.
Okay, that's
okay.
it.
All right. So now we know what it is. Now let's just do a comparison. As I said, there is no good and bad. It's not like one configuration is better than the other one. In my mind, there's just trade-offs. And for me, it's a matter of what environment are we in, and you know, what am I comfortable with? So that's how I kind of look at these things. But we do need to understand the differences between the two. For instance, you know, comparing this, okay, and let me just uncheck that and increase the quantity here by 2 so you get the same thing. So, you know, how do we compare this with this? How do we know one versus the other? So I have different categories of comparison. One I call stability. And how stable is the structure? Well, when things go crazy, when there's a lot of volatility in the market, of course, we prefer to have what I call stability in our positions that can withstand market movement and volatility in the market. So in a high volatility environment, I think both trades are relatively equally stable. But when we get into a low volatility environment, my preference goes to the USB because it just has lower risk to the downside, and it just is a little bit more stable, and I have a little bit more of a fine-grained control as to how I am going to, let's say, steepen or flatten the T+0. I can, with slight modifications, and what I'm doing is I'm just adding 20 wide verticals. I'm not putting in large trades. You know, the tighter your spread is, and this is just a general observation. You know, people can kind of think about this and use this in any trade they're doing. The tighter the spread, the tighter the distance between your vertical spreads, your butterfly spreads, any kind of a spread you're doing, the more stable it ends up being, the more stable. So all I'm doing is tweaking the trade with relatively tight verticals, in this case 20. Can they be 10 wide? Yes. Can they be 5 wide? Yes. You know, then we get into issue of commission and things like that. But because of the tight configuration, there's quite a bit of stability in the trade. In a low volatility environment, because as you all know, when volatility expands, butterflies become cheap. You get a lot better price for your broken wing butterflies, for your spreads, premium selling spreads, like, you know, selling vertical spreads, etc. So the stability goes to this trade. Volatility regimes in DTE. In a high volatility environment, you know, when we're in the VIX in the 20+ range, I typically switch to a BWB. And the reason, we'll get into it, because now any kind of a stability advantage starts to shrink because of the high expansion of volatility, because the normal distribution curve just widens out. I think that both end up being somewhat equal. Now, when it comes to days till expiration, I bundled DTE with volatility in the same line because many people consider volatility simply synthetic time. Because of the primarily a contango environment that most of the time we're in, When you go further out in time, the volatility is higher, and therefore it simulates a high volatility environment. When you go 90 days out, 70 days out, implied vol is typically higher than the front, and that in a way simulates a high volatility environment. Butterflies get cheaper, BWBs become more stable and flat, etc. So that's why I kind of put them together, that in a low vol or you could say low DTE situations, if I want to trade something, for instance, going out 30 days or less, I would feel a lot more comfortable with this because it's a tighter package, and even shortening the distance even further than going with the BWB. So the next comparison is in cost. Typically, again, in a moderate to low environment, the cost of the trade, and by the cost, I'm not talking about necessarily the debit you're paying, but let's just say the risk, the real risk, which is down here. If we do the comparison, you see that the standard broken wing butterfly, again, a lot of times people refer to this as margin. I'm calling it risk, max risk. So in this example, and we're in live market, this one's going to risk about 12,000 to the downside and 2,000 to the upside. If we compare that with this configuration, it has about the same risk to the upside, and it has much less risk to the downside. So it typically has a lot lower risk, downside risk. Volatility skew, many people are familiar with that. Many people may not be familiar with it, but the skew is basically the variation of implied volatility in the same month between different strikes. And as many of you know, in equity products, and more specifically equity indexes, the lower strikes have a higher implied volatility. It doesn't matter puts or calls. The lower strikes have a higher implied volatility than the higher strikes. And that's called the skew. The skew with this trade, because it's a tighter trade, it's a lot more compact. The spreads are not as wide apart. It affects this trade a little bit less. It goes back to the stability argument. If you're concerned about the changes in skew or changes in volatility impacting your trade, when you create tight configurations, you're less impacted by it. So this trade is less vulnerable to skew. But when volatility expands and explodes and everything puffs up, then that difference kind of starts going away, because these things get very flat, very cheap, very stable as well. Commission. On the commission end, the BWB definitely wins. It just involves fewer contracts to trade. And as you can see the comparison here, we have 40 contracts going against, what is it? 64 contracts. So definitely commissions are going to be, if commissions are an issue for you, then definitely you would care about this part of it. Complexity, again, the BWB wins because it's a less of a complex trade, meaning that, you know, you kind of, you have, well, 1 by 2 by 1, you're just varying one variable and leaving it at that, versus this thing has 2 variables that it's messing with. So this one becomes a little bit more complex in terms of both entry and exits. The management, in my opinion, when we start tweaking this, it's fine. It's the exit that we have to kind of become a little bit more skilled at, and entry to me is also not a challenge. But I can tell you this, in terms of execution, if you start out with a balanced butterfly, a 1 by 3 by 2, or at most 1 by 4 by 3, then you can execute it as a package a lot easier. If you go to this types of slight tweaks where it's 10 by 32 by 22, they don't pick these trades up very easily on the way in, especially on the way out. So the way I execute these is, for instance, I get into the butterfly itself, and once I'm executed, that's the more difficult leg. The easier leg is selling additional verticals to unbalance it, right? So I enter it in terms of in that fashion typically. So before I jump into the next trade, kind of give you a quick overview of it, let me pause again, and I'll get into managing these things in just a second. Any questions, Tom?
No, still on the same one, so we're good.
Okay. So the next trade I want to show you is what I call the bullish Sphinx. The reason I call it this is because the structure kind of reminded me of the Sphinx. And what it is, it's basically a butterfly. And here's your BWB, standard BWB. And this is sort of like at the money. And this is the zero line. And this is the at the money. And it's basically a butterfly, a balanced butterfly below the market. And there's an added short put vertical component to it, which makes it a broken wing butterfly. Now, for those of you that might be confused about what I just said, let me just demonstrate that real quick. If I create a balanced butterfly, which is this thing right here, it's 1 by 2 by 1, and it's equidistant on both sides. And then I go to the 2800 strike, which is here, and I sell a 10 wide vertical 10 times. And when I put the two together, it basically creates this very first trade here that we had. In fact, if I turn around and sell that, you see that it cancel each other out. So that shows you that the two are equal. So basically, a broken wing butterfly, it's really a balanced butterfly with a short put vertical that intersects the lower leg and kind of rolls it down one strike. So that kind of explains this picture to you here, that a broken wing butterfly is really a balanced butterfly with an embedded short put vertical, a credit spread. And all I've done with the Sphinx is taken the butterfly and pushed it to the upside and kept or pushed the put spread to the downside. So it's kind of keeping the put spread here, just taking the butterfly that's sitting here and shoving it to the upside. And therefore you get this look, which kind of reminds me of this. And this is the bullish configuration. I also have a sideways market configuration and a bearish configuration, but I don't want to confuse things, just want to keep things straightforward and simple. And this is a configuration I really prefer and often trade in a typical bull market condition, which we're in right now. And here's what, in terms of in practice or realistically looking, here's how the trade may end up looking like for me. So down here, you see, for instance, that I have a 5-lot put vertical that were sold way down here. It's out of the picture. And in terms of the call butterfly configuration, you see that there's a 3-lot long vertical spread here, and there's a short 10-lot here, and there's another short 5-lot somewhere back here as well. That's out of the picture. And it's kind of creating a somewhat of a relatively flat or balanced configuration. By balanced, I mean in terms of your delta. It's a relatively flat delta. I try to keep these things with a slight bullish delta. I really don't like going short delta with these, and only because if there's a fast move to the upside, the position can get hurt. But these positions under most market conditions, let's just put it this way, under normal market conditions, which is most of the time sideways to leading up in a bull market, which we've been in now, but that's not the case for 2008 and 2002. We're not, those were bear market, but in a typical bull market condition, which we've been in, I prefer these trades because of the because of the better win rate, better profits, etc. So, and as you see that this is also an unbalanced skip strike, because you see that the distance between here to there is a lot wider, and there's a lot more shorter contracts out here than there are here. So it's like a 3 by 10, and there's an additional 5 back here. So these are my preferred trades in a bull market when we're in a low grind upwards volatility condition. So let's get into showing how I would manage this, which is Al's question. So I want to use an example that was already done a couple of months ago. This is in our mentoring forum that me and Charles are conducting. I'll tell you guys a little bit about it in case some folks are new, don't know about it. But this trade was actually proposed after we went through our month 3, where I talked about these trades with the members. One of our members, Bob, suggested a trade, and what he put out there I really liked. So I said, I'm going to take this trade. Actually, I'm going to do this one, and then you know, later on I show how I managed it. So this was entered in RUD. This is a 30 wide by 10 wide. So this leg is 30 by 10. So basically, to balance the things out, it's basically 4 contracts here going against 12 contracts there. So it's 3 times as many 10 lots as there is, 3 times as many 10 wide verticals as there are 30 wide verticals. So it's so the way I executed this was a 4 by 12 by 8. Then I sold 2 4 lots against it, so that created this kind of an unbalanced configuration. This was done on 7/10 and 7/11. Let's just look at the chart real quick of the RUT at 7/10 and 7/11. That was up here, actually. We were near the highs. So that was in retrospect. You know, it was right at the peak of the market. And what ended up happening was that there was a minor dip and a bigger dip that occurred, relatively speaking, following that. So what happened next was that the market dips on 7:30, and I made an adjustment. And on 7:30 was basically this day at the bottom, right? The worst place to potentially make a defensive adjustment to a trade, and that was right down here. And so what I did at that point in time was I took 6 lots of, remember, I'm looking at this as I have a bear vertical and I have a bull vertical. So what I did was I took, and it was basically 4 by 16, 4 by 16, 4 bear verticals, 16 bull verticals. So I took 6 of those 16, and I rolled them down. And I did that by purchasing a condor. By purchasing a condor, so I'm buying 6 of these back and I'm rolling them down. And in addition to that, what I did was I took the leg that was now in the money of the bear vertical that was winning, and I rolled it down by 5 points. So initially the upper leg was positioned at 1685. I rolled it down to 1680, and I got a $3.15 credit for that. And when I did this adjustment, what it did for me, it pretty much, if you look at what my downside risk was to begin with, it was a little bit shy of $5,000. And via that adjustment, I really didn't increase my downside risk by much. I increased it slightly to slightly over 5,000. But what I did was I created a lot more room for the market to be able to fluctuate. And Now, some people may say, well, okay, Ali, you've shown us the USB, which is great, and then you throw in the Sphinx trade, which is this guy. I mean, are they related in any way? I mean, what's the relationship between the two? Well, if you think about it, and if you actually look at this, what this ends up looking like, if the market ends up down here, what do I have? I have a bullish butterfly with a put vertical underneath it, right? So it's kind of, you see how the two trades end up morphing into one potentially, and becoming one if the stock continues, or in this case the index continuing to going further down, with the expectation that there's a butterfly on the upside of it, and if there's a bounce, the butterfly would win. So that adjustment was made at worst possible time, and then there was a let's see, there was a bit of a bounce. Let's see what happened on 8/8. On 8/8, which is, yeah, on that day. So after that adjustment down here, there was a bit of a bounce in the next few days. And what I did at that point, I took profit on the, on the minor pullback. On the minor pullback on 8/8, there was a bit of a pullback in the market. So market kept moving up and up and up after that. And there was a bit of a pullback on that day. I don't know if you could see it, like there was a bit of a dip in the market. And what I wanted to do is take advantage and start harvesting this butterfly and taking some money off of it. So therefore, I rolled the short put, the long put down another 5 points, got another $1.64 credit for it. So did the same move I did up here, just got less credit because we were at a higher strike. Now, if you look at the trade at this point, it's in a relatively safe spot in terms of, so I'm not worried about making this move and having it be the worst possible move at the worst possible time, because I'm still short deltas in the overall trade. And then on 8/8, what I did was to say, well, this put vertical that I'm short is really far out of the money. I've added a bit of a downside risk down here, so let me get rid of this guy. So I ended up buying back this put spread that I'm short down there for cheap. So I'm always keeping an eye on these put spreads that are sitting around that were sold short, or call spreads that were sold that are sitting around. And I want to put myself in a position where I got a decent amount of premium for it when I sold it down here as part of this condor. Now it's not worth keeping. So what I like to do is get rid of it and buy it back for cheap, which is what I did here. So now this took my margin way down and my total risk. So now I'm in a pretty good shape in terms of both upside and downside with this trade. And the following adjustments are just basically more tweaking and playing with the butterfly. So basically, this is still a bit unbalanced. This is an unbalanced skip strike, and I still have more risk on the downside to the upside. So I'm keeping an eye on these verticals here and what they're going for, that 10 wide verticals. And there was a bit of an uptick in the market, or market was basically near resistance, I believe. So I decided I'm going to buy some of this back for only 55 cents. Why keep that risk on for 55 cents? Get rid of the downside risk. And then what happened after that, I think the market just flapped around a bit, really didn't go up or down much. And now I'm sitting in a balanced butterfly, and I just kind of liquidated the whole thing on 8:15. At this point, it was a balanced butterfly, and it was just also easy to execute to get out. So the total net result was, it was a good trade, made close to $2 grand. But what I really like about this is the fact that I really didn't have to substantially increase my downside risk. that I kept it right around the 5,000 mark. And this one is misleading because this trade, both of these trades were done on 8/8. This trade was on 8/8. This trade was on 8/8 as well. So the margin really never stayed at whatever 7,000-8,000. The highest this thing went to was a little bit over 5,000. So with a margin of around, let's call it around 5,000, or risk of around 5,000, made about 2,000, which is pretty good. I'm always looking at my return on risk, not necessarily caring about, oh, I made X amount. I'm always concerned about what am I making on the risk I'm taking. So that kind of steps through explaining the adjustments I made for that trade. Any questions there so far, Tom, or are we doing okay?
John says, what was a DTE when this trade was initiated?
Okay, good question. So let's go back and take a look. So this was initiated on 7/10, and this was looking at August 17th expiration. So it was a little bit over a month. Anything else?
Oh, nope, no more questions.
Okay. Now, in terms of you know, other aspects of it, okay, exactly where do you place this, and how do you come up with the strike, and what kind of credit? Those types of things are a little bit more time-consuming to discuss. We don't really have time to get into all the depth, but bottom line ends up being that when I'm buying a vertical spread and I'm selling, I kind of take this trade apart. And when I get to my philosophy section, I guess I'll kind of explain some of that just a second. You know, some of those questions would be answered there as well. All right, so that's that. Here's another one I just want to show real quick that was also in the forum. I just want to show with this trade, this was not an official trade, paper trade that we kind of do every month. This was more of a just showing people what's possible. Here's a Tesla trade. Tesla, as many people know, is just a very crazy volatile market stock. And when I find a very volatile stock or under a volatile market condition, what I like to do is try to build a butterfly as cheap as possible. If I have a strong opinion about very short-term direction, I'd leg into it. But I try to get into something cheap and then leave it alone. And then just kind of let it sit there and let the market flap up and down. And then through harvesting techniques where you liquidate legs at various strikes, kind of chip away at profits for this trade and end up getting the expiration line above the zero, which is get my initial investment out of the trade. Now I'm playing with the profits, and then see how much more money I can eke out of that trade as well. And these are very stable, very, in my opinion, relatively safe trades to do, especially when we're dealing with either a crazy stock or a crazy market condition. And as you can see, this is also a skip strike. And what I'm doing here, I'm just kind of legging in, constructing it, selling a credit spread, buying a debit spread, then buying more debit, and just kind of, as the market's moving up and down, and kind of just adding to each side and kind of building the trade that way. So the reason I'm showing you this is because there's a lot of different creative ways we can take these butterflies, and it's just not like an index trading thing. You can use stocks and everything else for it as well. Okay, so here's my philosophy or my general approach to trading these things, and this potentially answers some of the question in terms of, when would you enter, why would you enter this and not that, etc. Leverage and tail risk. I'm very big on not overusing leverage and very wary of tail risk. I'm not fan of trades that use a high amount of margin. because those really concern me, scare me in case of a big market move. So I am more in favor of trades that use less amount of money to make more money with it. Which brings me to this point. I like to get higher reward or return on the risk. So I'm really not like the first broken wing butterflies that I showed you guys, where I was, putting them on, getting out with 5 to 10%. I don't trade that way anymore. My target is, minimum around 25 and percent return on my risk, if not more. So on majority of the trades that I do, which is point number 3. What I do is I avoid very high probability trades where the probability is based on the option pricing probability. So when we get into the situation where, okay, I'm putting this butterfly way out of the money, or selling really cheap premium to get a 95% win rate, that's not for me, because big market moves do happen, and people that make money using that approach could end up being hit. And I know some people get very fancy with all sorts of Greeks and second order Greeks, and come up with really creative trades to mitigate that tail risk. The problem ends up being is that no two crashes are alike. So people kind of use the 2015 August as the, if I backtest my system, it did really well, it survived. Well, that's n equals 1. That's a sample size of 1. Each crash is a little bit different. So it's really not possible to truly test something and come up with a definite answer that this thing works. That's number 1. Number 2, all the trades that are heavily based on Greeks are not carved in stone. They're actually estimates. And when you need them the most, which is in total chaos, is where they can malfunction. So, and it's okay to use the Greeks, in my opinion, but if you're overly dependent on them to work perfectly, otherwise you can lose big amounts of money. To me, that's a very dangerous way to trade. It's not for me. Dynamic rules versus static rules. I pay attention to what the volatility of the market is, what the option prices are in terms of placement of strikes. So the rules that I use are not static. It's not like, okay, always go to this strike, that much out of the money, place the spread that wide. The width of things for me get adjusted, and the placement of them get adjusted based on what the volatility of the market is. And I'm also, I kind of implied this, but I'm also price focused. I do pay attention to Greeks, but in a general way, I like to know what the Greek of my portfolio is. I like to know the overall Greek of a big position is, but I'm not super focused on it. What I'm more focused on is what these spreads are going for. And as this example that I was showing you guys, what I was doing with this was keeping an eye on these spread values. Okay, now this one is too cheap to want to be short, so I'm going to buy them back. So my focus is on stuff I can buy back for cheap and sell at a higher premium. Sell at a higher premium, selling stuff for $3, $2, etc., and then buying things back for 25 cents, 30 cents. To me, I know when we start trading, people kind of pay attention to the expiration graph, which is the blue line. And then when people become more sophisticated, they kind of put that aside and become a lot more focused on your T+0 line and T+5, 10, etc., which is the present line, which is fine. That's good to know exactly what that is. But to me, expiration graph is also important. And the way I look at things is that when I place a trade that looks like this, and let's say I'm putting it out of the money back here, I'm not thinking, oh, I want the market to go up. I'm actually thinking I want the market to go sideways and slightly down. Now, I know that's not reflective of the T+0 line necessarily, but if the market does that over the course of the trade, then the trade should be a winner. So what I'm saying is that I'm not going to put a bearish or let's say a put, a massive put broken wing butterfly or a USB if I think the market's going to shoot up, because that trade, I'm going to have to then struggle with that trade. I do want a bit of a bearish lean in the market to put this thing on, and through management, I'll chip away at the profit and the risk over time. So I'm kind of looking at it like a 4-year-old. I'm kind of saying if I'm putting something below the market, that means I want the market to go relatively down, but not too much. And the approach I use is an adaptive approach versus a static approach. Again, paying attention to volatility and price action and the market conditions. In a typical bull market, what does the market do? In a bear market, what does the market do, etc. I'm also a big believer that if we want to succeed as option traders, we have to develop our skills. It's really not, you know, it's not realistic to think that I can, like a robot, execute a trade that's fairly mechanically simple to execute and be able to sustain profits for decades. I think traders that make it for decades are the ones that end up developing skills. So just like any other, and the reason I'm putting these things on is because I've encountered these questions. I've encountered people coming to me and asking about, oh, can I, you know, I want to make X amount of money so I can quit my job a month. Can I do that? Okay, how much money do you have to start with? Oh, I have that much. Well, maybe you can, but you got to get really good at it. So it comes down to developing skills. And stop losses, especially bullish equity trades. I'm not a fan of stop loss. I'm not a fan of stop losses. If you actually test this, and you'll see that stop losses contribute to losses. But we still need to control risk, right? How do we control risk? We control risk by the position size, by making sure that we're not overly committed, and by managing the trade actively, by moving things around, by rolling things away and rolling things around and extending the duration of the trade, doing all sorts of things. And so that's my philosophy, that I'm not a fan of saying, now in some trades you have to use stops. You know, like if you're doing a very cheap credit spread, then you're kind of forced to do it. I do utilize credit spreads. In fact, when you look at trades like this, it has a credit spread component to it, but the credit spread component has to be valued correctly in order for me to want to sell it. It has to have a good price in and of itself. So by not selling cheap stuff, it gives me sustainability in the trade, and it also, not over leveraging, it gives me staying power. So that's why I can underemphasize stops. So that's the end of that. I can take some questions now, and if there are any, but real quickly share with you guys that, as I alluded, that there's a mentoring program that Charles and I are running through Tom's site. If you're interested, every month there's a theme or a topic that we cover. In month 1, which was May, we focused on credit spreads, and in month 2 we covered debit spreads. And some people say, well, I don't trade credit spreads, or I don't trade debit spreads. Well, but I do trade butterflies. Well, if you're trading butterflies, which is just butterflies, condors, all of that is our wing spreads, they're made up of credit spreads and debit spreads. And like I was saying, the way I view these trades is and my placement of the strikes and where I would sell the credit spread has to make sense on its own. This credit spread that's component of that has to be worth selling in order for me to want to sell it. So therefore, understanding credit and debit spreads is kind of like a prerequisite for getting good at wing spreads. So we kind of covered wing spreads. We went into time spreads, one of my favorite strategies I covered in SPX that I like, the type of calendar spreads that I do that I call lean calendar spreads. And last month we covered just long-term trades with dynamic hedging, how to establish a long-term position in a stock or an index you're long-term bullish on and hedge it, dynamically hedge it, sort of like a dynamic collar, but a lot more, a little bit more sophisticated. And this month our focus is on managing and adjusting and hedging trade. So get into all aspects of trade management, adjusting, things like that. If you are interested, there's a package for both me and Charles. It's for $200 a month. You can go to that link. If you're just interested in my mentoring, it's $125. That's the link. If you're interested in just Charles's mentoring, that's the link. So go to aramir.com, Charles, Aramir Ali, or Aramir AC for Ali and Charles. If you want to find out more about, in fact, if you go to this link, you'll see that there is a little bit of a write-up on, there's Charles, there's me. There's a free presentation we did. You can take a look at, there's some Q&A about the program. And if you have more questions, you want more details on it, you can email me. And if you're interested on purchasing prior months, you can contact Tom. The prior months are available, for basically same pricing that the participant paid at the time. So the other thing that I wanted to real quickly mention is that we have forums which are very active, where people post questions and comments, etc. And I do show or demonstrate these trades via paper trades. This is not a alert service. It's more of a, hey, let's demonstrate how, the concepts are implemented. But, just to show you guys, I mean, Al was asking about this. There's a current RUT trade that I may adjust today. Yeah, I think it's getting to a point where this is the exact configuration you saw that I put on RUT. And I'll probably gonna make the same adjustment that I just showed you guys to it today if it stays around these levels. And then here's a SPX, and as you can see, it's kind of very stable, very, we've had huge moves in RUT, and this thing is, barely down a little. Going down to S&P real quick, this is a, no, not that. Yeah, I have a incomplete Sphinx trade that's being developed. So this is a bullish butterfly that's up money, and if we sell off enough, I'll consider selling a put spread as well. And but this is kind of a long-term trade. This goes out to January. But the thing I wanted to show is that this particular account started as 100,000. It's up about 4,600, and this is basically just a couple of months and doing trades that are no more than 5,000 in risk, but most of them are really more like 2,000 in risk. So getting something in the order of 100 to plus % return on risk in a couple of months. And the reason I'm showing you that is just to show that it's possible. You really don't need to kind of go out there and risk 100,000 or use 100,000 margin to make 2,000-3,000. It's possible to risk less to make more with butterflies, condors, broken wing butterflies, etc. And we're kind of showing that in our paper account that we've been doing that and this one just started a couple of months ago. Anyways, that's it for me.
There were
1 minute overtime.
Oh, there were a couple of questions though. Luke asked, is this purely directional method to generate the trade adjustments, or have you thought about turning it into a systematic approach so you could truly back test it?
Right. So it doesn't have to be directional trade. You can base things on, base trades on delta neutrality. I'm assuming he's talking about the put USB, I believe.
I think so. It was about 17 minutes ago.
Yeah. You can build backtest rules around it. You can say, I'm going to start out with, with this many days before expiration, place it at this strike, look for that credit, and if it hits this level, I'm going to do that. It can be tested mechanically. You can set a maximum stop loss on it if you like. So for instance, we could say that for this rut trade, the most I'm willing to lose on the overall package is about 50% of this. So it can be tested. Just to kind of demonstrate that if you overall generically traded this, what it would do. I don't trade it mechanically. As I mentioned, I trade it dynamically based on market action. And I'm not necessarily always speculating where the market's going. If I have a strong feel, I may leg into things. But oftentimes when I do these trades, these types of trades, I'm starting out with a relatively stable low delta trade.
Okay, and then Sam had a question about the bullish Sphinx. He said, is this your main bullish structure for SPX? Does it take into account the IV skew on the upside? Do the strikes of the Sphinx depend on the IV skew? So I guess a couple questions in one.
Yeah. Oh, that's a good question. I forgot to mention that. Yes, it's the primary trade that I trade in a bull market, which is what we've been in. I mean, we've had a few days of a pullback. Again, in my opinion, yes, this time could be different, but most dips are at least had short-term bounces. So the first part, yes, this is the primary configuration I use in SPX in a bull market, which we've been in. And how have I taken into consideration the skew? Yes. The butterflies on the call side are going to be more expensive than on the put side. But I think the misunderstanding is just because the butterflies are more expensive because of the skew, therefore they're not good. You have to compare apples to apples. You have to compare a call butterfly to a call butterfly. Yes, it's more expensive, but if by placing a call butterfly on the upside, what you're doing is you're, go back to this real quick, you're getting rid of the tail risk. Now, in this case, I'm very careful about the put spreads that I'm selling. I'm not, like as you saw with this actual trade that I'm in, I haven't even sold the put spread yet, right? So if market crashes, I know exactly what my risk is. I'm not worried about crash protection for this trade. And you have to compare apples and apples and kind of say that, is this call butterfly relatively cheap compared to typical call butterflies in SPX? So it's an unfair comparison comparing calls to puts. And so what gives them an edge, in my opinion, is because there's a natural bullish lean in the market. And this has historically been true for decades and decades. If you randomly buy SPX and sell it 30 days later, under all market conditions, you see that the distribution isn't like the normal distribution curve implies, that there's a 50% chance we'll be up and a 50% chance we'll be up. 30 days out, there's a higher probability that the market would be higher than lower. When we're above the 200-day moving average, which we can use as a measure for whether we're in a bull market or not, when you say, what percentage of time are we up when we're above the 200-day moving average 30 days into the future? You see that percentage jumps to over 60% of the time. So there's a natural bullish lean in the market, especially in bull market conditions, and that lends itself pretty well to the call butterfly, despite the skew.
Okay, a couple more, we're done. Would you consider to put on a USB selling in ratio of, say, the highest strike to lowest 2 -3 + 1 as opposed to 1 -3 + 2?
Doing what as opposed to that?
Oh, just have your 2 on the downside instead of the upside.
My 2
I
on
guess
the down.
the highest strike being +2, so +2 -3 +1 versus from the upper strike to lower +1 -3 +2. So basically reversing the direction.
Oh, reversing it? No. No. I like this configuration because if you try it out, you'll see that it has lower risk to the downside on the most cases.
Okay, and Luke, hi Luke, by the way, he said not directional, discretionary method, like in discretionary versus systematic. He's talking about the back testing stuff.
Right. So yes, you can be mechanical about it and test it. I don't trade 100% mechanical, but it can be done.
Okay, and Ted says he likes the Sphinx with stocks, seems to have worked really well, and a couple of thanks for the webinar. So I think we're done.
Okay, great.
And just a note before everybody leaves, on VIX Central, the term structure just went into backwardation again, so the market's still kind of nervous.
That's true. That's very true.
All right. Well, thanks, Ali. Thanks, everyone. And for the people who are registered who don't have AirMirror accounts, I'll create those for you, so you might get an email with a login or two. But thanks for coming. Really appreciate it. And check out Ali's mentoring. It's very popular, and people like it. And Ali and Charles both do a great job. So thanks again.
All right. Thanks, Tom, and everyone else for participating. If you have any questions, shoot me an email.
All right. See you, everyone.